Hello, everyone. Welcome back to the MHP Show podcast. I'm your host, Derek Vickers. And on the MHP Show, we are talking anything and everything that has to do with mobile home parks, operations, raising capital, doing deals, current market environments, anything about this industry and how current events can affect this industry and what have you. And I've got a guest on with me today, and we'll get into that in a second. But before we get started, just wanted to throw out and talk a little bit about what we're doing at Victory Capital. And so what we've really started to do here is we're helping 7 and 8 figure business owners. You got a business, you're busy every day, you're grinding in the business, but building wealth in real estate and specifically in mobile home parks is something you want to do. Well, that's who we're catering to here at Victory Capital. We can help you grow your wealth. We can take care of all the crap. We deal with the tenants. We deal with the crazy stuff that happens. And all you do is sit back. And if you want to learn more about Victory Capital, please reach out to me at derek@victorycapital.com. Or you can send me a message on all the social media platforms. I am not very hard to find. If you tune in to this show frequently, I'm not hard to find them on all social media platforms. So getting into the show today, I got a very special guest with me, and he's been a hard one to get on. I got to tell you, this guy, Lee and I are good friends. We hung out in California. I don't know. When was it, Lee? Maybe a year ago now?
Almost. I know you were enjoying the pasta and meatballs at that
Oh,
meeting.
man, that was, I still talk about that place because my wife buys Rayo's sauce.
Yeah.
And I'm like, man, it's nothing compared to the actual Rayos that we were able to go to. And I
Yeah, we
enjoyed
should
that.
get a bunch of your attendees. You come out next time, we'll take over the restaurant, maybe get a discount on that special Sunday gravy.
That Sunday gravy.
Enjoy.
Yeah. Well, that'll be exciting. Well, Lee Mechams, Lee is with Parkbridge Capital Group. He has lots of experience in the mobile home park business, and just wanted to welcome Lee to the show.
Thank you.
Yeah.
Thank you, Derek.
For sure. So Lee, I know before we get into some different topics that we're going to talk about today, just give us a little bit how'd you get into the park business? How'd you stumble upon it and what happened?
I started out in the real estate business at a young age, let's say, shortly after graduated from college, University of Oregon. Go Ducks. In any event, after being in that business for a while, I was doing some apartment brokerage. And it's a time when there was a tough point of the business cycle. We were looking after syndicating some apartments. I was with another partner of mine. We saw the apartment market getting shaken up a bit in that people were moving from their one bedrooms home and one bedrooms going vacant, people doubling up. But notice that the a mobile home park sector, particularly the 55 and older, was experiencing nothing negative during the business cycle. And so we, rather than continue on with the syndication of apartments and self-storage, went out and bought a 55 and older mobile home park in Portland, 72 site park. At the time, we had the seller carry and so forth. But anyway, that launched me into the mobile home park business. Bought another one after that in Portland. And Portland's a very solid town for the mobile home park business, real quality type of assets, mostly. And went forward from there, back in, let's say, the late 80s. This might be dating myself. Late 80s, I was probably, 11 years old by then. But in any event, so I formed an alliance with an investment firm based in the Monterey Bay area, Ellenberg Capital. That company is, when I went to work with them, I went on to take on the acquisition side of the business. And they had about 4,000 sites at the time, and fairly high quality, actually. And we geared up and formed some alliances with different partners and funding groups, and was with them till probably, let's say, the 2000. And accumulated a portfolio of, let's say, 35,000 spaces of 65 parks in 14 states, 14 states. Real prime portfolio. Most of it was then sold off at the turn of the millennium to different entities, including ELS and CalAm, which is big investment firm in Southern California. From there on, I just went out and did deals on my own, represented certain investment groups and so forth. And so that's it. So over that period of time, following that, the last 5 or 6, 7 years or so, I mean, just look back. So that's a quarter century since the turn of the millennium. Been doing more on the RV park side, which is, different than the mobile home park side. So anyway, in my experience, in current dollar values, which I think is more representative, have done about $2.5 billion of park purchases, maybe 150 deals. And over a long period of time, of course, I was actually involved in 1991 with helping align the first CMBS financing ever with Daiwa Securities. There had been residential REMICs for years, but this was the first commercial CMBS loan for about 100 million, mostly all mobile home parks, actually. And that was an interesting time going forward. From there, we did another follow-on CMBS loan with CS First Boston. And that started that was the initial area of that business, which has changed dramatically and really become, of course, as you know, a big part of the financing spectrum for mobile home parks in particular, not so much RV parks, but some, depending on their makeup. Let's say if they're more of a park model resort or more firmly entrenched in terms of permanent residence, then that as well. But been involved with many financings with life insurance companies, Fannie Mae, CMBS, and so forth. So it's been an interesting time, having watched the business evolve over the years. It's been a little bit more interesting to see over the last 5, 6, 7, 8 years with the very low interest rates, to see cap rates drop, because when we were buying, let's say, 5-star parks at the golf course, pit set, 700 units out somewhere between Tampa and Daytona for, an 8.8 cap or something. So those caps dropped in half, and
sure,
making a paradigm shift to buy into the area where people are buying mobile home parks or manufactured home communities, the 4s, in some cases here where I'm in Southern California, 3s, perhaps. I know a monumental transaction just happened in Malibu, and I can tell you, that was a very low cap. But then that was very unusual. It's probably one of the most valuable pieces of land in the United States. It just happened to have a mobile home park on it. In any event, that's a quick ramp up to where I am, what I've done. And, we pretty much self-manage our own deals. I currently today put together groups with high net worth investors, mostly friends of mine, and so forth. So probably picky at what we buy. I've already, assembled a big portfolio, not doing that again. But that whole portfolio I explained to you of the 35,000 spaces or so, most of it has been sold off many years ago. So that's that, Derek. Here we are, and seeing the next generation of superstars. Not that I'm one, but you look like you may be.
Wow, I appreciate that, Lee. I appreciate that. An 8.8 cap, 700 units between Tampa and Daytona. It sounds like you're in some alternate universe. I don't know what that's like.
It's a time machine. I was in a time machine. So that was a spectacular property, in and around the Plant City market. You would probably know that property. Most everything around, I think, is owned by ELS or Sun now. But yeah, look at, things have changed dramatically. We had an amazing property down in Sarasota that we bought, say it's 30 years ago, so it's a lot of time, but that goes to show the value of time holding a real estate. But this was about 1,000 units in Sarasota that we bought for about 27,000 a lot. Was sold 4 years ago to an investor for 170,000 a lot. So there you go. Time treats you nicely if you hold for the long term, and then there's the short term as well. Did I lose you? Derek, it seemed like I might be alone. Ouch.
WTF.
Ouch.
Yeah.
Blew up over there, huh?
Well, you should have just taken over the show, Lee, and I could have just been like,
I'm fine. Go ahead. Go out and make some lunch or dinner, and I'll just continue on here as if I knew what I was doing.
Yeah. But I know we were talking about how you mentioned, an 8.8 cap in, some of the, the Central Florida market from Tampa to Daytona. I mean, that's just, you can find some of that stuff via value add property now, but institutional quality asset, good luck. You're not going to find that. You're going to be exactly as you said, half of that. I think we saw a deal trade for like a 2.8 cap in 2021 in Florida. And so, that market's changed, and I don't see it ever going back to that.
No, I don't either. I mean, this was done, that particular deal was the mid 90s, and, as part of a spectacular property. I think it's owned by either ELS or Sun now, and you would know that market. And you're right, that type of property now is, or I don't know what it is exactly, but it's 4 to 5 cap, let's say.
For sure.
Probably, I don't know, so much dependent upon how it relates to debt. But yeah, you can find 8.8s like what you're doing in those markets in and around that corridor, or even anywhere in Florida, or higher. But it's just dependent. It's very quality related, just like it is in apartments. I've seen, however, the very super high-end manufactured home communities are selling at a cap rates less than what institutional quality apartments are selling for. And a lot of that has to do with the scarcity of the product, the failure that you would get a competitor coming in, the barriers to entry are way higher. So those super high-end manufactured home communities probably are the most pristine asset that you might own, particularly, depending where it's located, of course. Central Florida might be a little bit better than being on the beach in St. Petersburg this morning. But so you have those phenomena that are related to natural disasters that could mitigate the value. However, mobile home parks still remain to be, as they have been, just a spectacular way to get your capital placed. And as you said, as you're the money raiser and run these things, to give people you're the one that wakes up at 3:30 in the morning, not them. I'm the one that wakes up at 3:30 in the morning, not them.
Yes.
There's no perfect world, so you have your ups and downs in your investments, and whether it happens to be a stock, a mutual fund, whether you do rental housing or anything, you're going to have swings in the market and difficulties that you have with transactions. But that all goes into your what you would stipulate as being your buying criteria, whether you're happy to buy stuff with private utilities versus public. That's a big deal. Aging infrastructure is a big deal. Markets are a big deal. So a lot of things go into the calculus of doing an investment. I'm sure, as you know, and a lot of your people that are watching know. But yeah, so that's just a generic piece of data having to do with the mobile home park space that you're in, that I've been in for some time.
Yeah. What do you say, like, the current economic cycle that we're going through now? We had historically low interest rates for, years, right? Which definitely pulled cap rates down, and it made the market, it was just crazy in 2020 and 2021. And with your experience and seeing different cycles and things, like I guess, where do you think we are in the cycle now, and where do you see it sort of going?
Business cycle is an interesting thing, and it's not something that occurs only once. I mean, we're seeing it now. A lot of people are experiencing those guys that have been in the business, let's say, for 10, 15 years, where it's kind of a new thing. Having gone back, decades before that, I mean, I was really early on and young in the business when the interest rates were super high, and Paul Volcker had to crack down by really ramping up the rates to around 20%. So what the Fed has done in this go round is rather benign compared to what happened then, or even at times following that. But it's been very painful because if your interest rates are high, you're borrowing, if the cap rates don't change from before the interest rates went up, your returns drop dramatically. Therefore, a lot of people backed off from the market, and I think that's been, if you talk to brokers out there, their transaction volume this year, last year, wasn't like what it was 3 or 4 years ago. So where are we in the business cycle now? Well, apparently the Fed has decided to drop rates somewhat. And while they were apparently somewhat high, I mean, historically, I don't know if they've been that dramatically high. I think if the long-term rates for debt settles in around the mid-5s, it's probably more of where we might expect to see things again. I don't know how we get down to the low rates we had in the past, which, in some you can structure deals, you can get return. Although it's kind of a spread between the debt cost and the cap rate. So we are now, we're at this apparently a point in the business cycle where
I don't know if we lost Lee.
Here
Did
we
we
are.
lose you, Lee?
Inflation seems to be tamped down, apparently, by the metrics that they're using lately. Money supply really grew dramatically, so flushed out of the market. I don't know if that's been completed yet, but it's nice to see the rates coming down. Of course, as you know, sellers are really reluctant and slow to move cap rates up when interest rates go up. Conversely, however, they're pretty fast to move them down if interest rates move down. So it's sort of not a perfect market. It becomes rather fluid at times. But yeah, so it's just something we have to work our way through. I think it becomes somewhat difficult to do deals when interest rates are high. But there are those people who are motivated to sell. It's not necessarily the property has a problem. It's usually the owner has a problem. So, and sometimes the property and owners are the same problem. But that's where the add value stuff, I think, comes in. But I've seen this happen before. Sort of not as fun as when interest rates are lower. So it's a tough time. So you have to more or less focus during these times on your portfolio and do what you can to improve that and the operations of that. And look for the deal that makes sense. I have to admit those have been fewer. I just haven't really been interested in, haven't found anything interesting to do, very limited. I'm looking to get a deal closed the next 60 days, but that's been ongoing for a while. And but it's an RV park. And by the way, I mean, the RV park business is a cousin of the mobile home park business, but actually quite different.
Oh yeah. Yeah, it's interesting because, like, we've got a deal closing on Monday, and like, we closed a few deals last month, and we got, we've been, moving a little bit here in the last couple of months, and investors are like, "Oh, you're just, you're finding deals." And I'm like, "You don't know how many deals I look at. You don't know how many deals I say, like, absolutely not to on a weekly basis. Like, I'm always looking at deals, and I'm quick to, like, I mean, once you're in this business and you've seen enough deals, like the deal that, like, oh, that's a great deal. We're getting that one, right? It just pops, and you get this. Your little tuning fork goes off where that that's a good deal. And despite the higher interest rate environment, there are deals
Buffering over there, huh? Oh, there you go.
you got me again?
Yeah.
God, man. Yeah. So what I was saying is that, yeah, you're right. It is less fun because the acquisitions and things are the most fun part of the business, but you have to stay disciplined. You have to keep, looking for deals, and then you'll find some. And,
Yeah.
I think the Fed lowering rates a half a point does help. Where I think it hurts is that what Lee mentioned earlier is that, the seller is quick to lower the cap rate back down. Oh, the Fed lowered rates. Now we can sell the park again because most brokers called, the Wednesday of last week, the day after it happened, and said, "Hey, didn't you see interest rates are dropping? I can sell your property again for a 4 cap." I know that happened, and
Yeah.
it's so I think it'll be a good and bad thing. Who knows what they would it? I mean, what do you think they're going to lower them again before the end of the year?
From what I've read, I mean, I can only extract what various pundits are saying, but it might be they might do that. I mean, business is really slowing down, actually. So, in order to keep employment up and the economy running at this critical time, coming into election, particularly, I think there might be a little bit more pressure from someplace on that. So I wouldn't be surprised, the quarter, maybe half, which would be very welcome to the borrowing market. It's been, if you are an institutional borrower, and most of the deals we're doing are, let's say, 4 to 9 million. So the borrowings are a little bit different, but they have become, boy, it's just changed a lot in the last year or two, where lenders on our side there might be a local bank or savings bank. There's a couple out in California that do quite a bit of business. They were asking that you take 10% of the loan amount, 10% of loan, and set that aside in a savings, a permanent savings with them. So if you're borrowing $4 million, you got to get $400,000 extra capital at the end. Set that aside, let it earn what? Certainly not what your deal's making.
No.
So that's made borrowing difficult for certain borrowers. I think that there are a lot of pretty good mortgage brokers out there and lenders that can find deals that are more favorable. But then it's not easy. You have to be kind of got to know what you're doing for these lenders these days, because everything in the world of investment is related to risk. And there's so many things that relate to risk, like everything. So the borrower and their experience has something to do with that. Hence, you probably have a more easy time borrowing than, Dr. Gears 2 miles up the road that's got another doctor that's buying a 49 space park out there north of Winter Garden or something. So, yeah, it's an interesting phenomenon.
Yeah, for sure, for sure. It's interesting, and we've had, I ran into some lenders that were saying the same thing, like you got to keep 10% in reserves here, and it just kind of like, didn't make sense. We never did one of those deals. And I think it speaks to, now the leverage that we're getting on these deals is less. We have to bring more capital to the deal. Um, even with some of the value add stuff that we were buying in 2021, we were still bringing, 45% of the purchase price to the deal. Now we're at like 55%.
Interesting. So those are serious add value deals, I suspect. Huh?
Yeah. And I like to, I bring more in for reserves for CapEx, and like I'm going in and getting quotes on everything that we need. So I'm going to bring all the money up front. If we're doing any infill or whatnot, that we have to do any lot prep, I make sure that we have those funds up front so we can go in and like, hey, implement the business plan quickly and not depend on the cash flow, which is a huge mistake because you know how these things are. In the beginning, in the first year, you're not going to have enough cash flow really to do all the stuff that you want to do. And I think it's important. And I think my people that listen to this podcast will, I belabor this point that, like, I still see people screwing up where they're like, they go light on the capex or don't bring any more money to the table. And then a month into the deal, they have to fix, 10 electric poles and they don't have the money to do it. So
That's right.
the
I think that's a
problem.
very important component of the syndication side, or where you're being the GP to get extra capital for reserves. And I have this of the same mind as you as with respect to leverage. Um, my investors, I like to say a little bit safer, so probably 65% or less LTV, loan to value, copious reserves for capital expenses. If we're doing like an expansion on a park, which I've got 3 properties now that we're doing that, but I won't raise the capital up front for that. But that would be, I have my operating agreements designed to be able to do partner loans. So when it becomes appropriate, we just do a little separate funding from that and raise the capital at that point, so it doesn't punish the returns earlier on. But I think it's always really smart to make sure you have some money in the bank, because you don't know what's going to happen. I mean, wait, what if your whole septic system goes down? Then you have a real problem. And that's another thing with respect to investing these days is the paradigm, the 2 different paradigms of private versus public utilities. It's a lot more focus these days on what goes into the ground, and particularly as it impacts the aquifer. So in Arizona or Texas, where we have a lot of stuff in Arizona, I'm dealing with something where they're testing. A big deal out there is the nitrogen loading going into the soil. So if you have septic systems, private utilities, the effluent comes out, and most of it, or a good portion of it, becomes a nitrogen product, and then gets down into the aquifer. If it gets low enough, your nitrate levels go up in your water, and all of a sudden you have 2 problems. So that's a really big deal that I would caution people to be super careful about in buying, is to be mindful of the risks that go along with a private utility system. Now you price it in and go, well, if I'm buying private utilities, my cap rate should be X higher than if I had public utilities. And after you've run into a real issue with a private utility or two, it certainly makes you more religious with respect to your preference of your utilities. Now, in the business that we're in, a lot of parks that were built many years ago were built in areas where there were no public utilities. So you have to deal with private. But that again becomes more of a consideration that you got to have that capex set aside. You better check those systems out well. And because if something goes wrong with your septic system, it's super expensive. And by the way, it becomes an environmental violation, and all of a sudden you find yourself in real hot water. So I think those are just a couple of things these days as people buy that they don't take lightly. All you have to do is experience it one time. I'm not doing that anymore. But if you're going to buy in volume like you are, or like we used to do, private utilities are fine. We had a 1,000 space park in Sarasota that had a massive, that was two parks divided by I-75 that had a massive private utility, but it was run like a real business. So that was fine. It's far different than some of these parks you might see that have a small septic system or sewer lagoons, which, aren't particularly attractive. Some people buy them. In any event, that's just a word on, on acquisitions with respect to that part of the risk equation that goes into buying, and the necessity for CapEx or even designing your operating agreements that allow you to get uh, lender loans, or excuse me, partner loans.
Yeah. Yeah. How would you, if you were, if like when you're buying a park with private utilities, like when you're underwriting, like how do you, let's just say you do an inspection on the septic system and you're like, okay, it's fine. There's nothing that needs to be replaced. Like, are you still bringing reserves for that?
Yeah, yeah. Bring reserves for anything,
Yeah.
anything and everything. So um, a lot of the reserves might just go into over the first year going into landscaping upgrades or rehabbing a home. Now, I know some of the stuff you do have park on homes, so you're going to do the rehab there. That's a business haven't been involved in. We've had some, but it's a specialty. That's a niche. The park on home niche. It's Some people are quite good at it, like yourself, and some people take on parks that are exclusively park on homes, which is different than the business I've been involved with. But it is, a great way to get returns. It's a bit of a rodeo, of course, as opposed to buying, a 5-star park that's on private utilities and very established and mature population, or one that's not, that has park on homes. Some of the homes being, older trailers coming from the 60s and 70s. It's a real expertise to rehab those, put them back on the market, and turn that into a profitable asset, which I know you've done. It's a real skill that comes with experience.
Yeah. Yeah. I mean, the stuff you buy in Florida, the Florida specials is what I like to call them. Like that's what you've got. You've got 60s and 70s homes in there. It's dense. It's an old park. I mean, there's a lot of private utilities in Florida, and you're going to deal with that stuff. But we figured out ways to, we've built a business model around on how to make those profitable. Because even if you go into these 5-star communities in Florida, they've got old homes too. I mean, they're old homes that people have rehabbed. They have, they've put a new room on them, and they look good. They look good when a home's painted and it's clean. Like it looks good. Like one of the parks that we just bought. I mean, I think all the homes are like 70s, late 70s homes, and they're all painted. Everyone takes care of their home, like, and it looks good. It's clean.
Absolutely, absolutely. We have a property we manage up in near Clearwater, and same situation. Park built in the 70s, so it's a lot of the older homes there. But because the area's become, I don't know, more desirable, we'll have people on turnover. They'll put vinyl siding on their homes, and if there's one that gets sold that the park owns, and we'll spin it off to somebody to do rather than do it ourselves, we require that new vinyl siding. That really changes the look dramatically and gives them, a new life.
Yeah.
That and having to do something in the interior as well. But that's a specialty business. You're remodeling manufactured homes or old mobile homes.
Yeah.
But they do look good. You're right. It absolutely can transform the community.
Yeah, it was in one of the parks where all the houses ended up being, sided and skirted. And
Yeah.
I forget who I was talking to. I think I was talking to the engineer that was doing the due diligence on the treatment plant before we bought it. And he was like, "Yeah, I drove by this park and it looks like you guys brought all new homes in there." And I was
Yeah.
like,
Right. Huh?
"No, no, we did not. The same old homes, but it really does, change the look and feel of the park." I remember the first park that we bought, we did that too, and I had the contractor come in and side and skirt this old. It was old, maybe 60s. And after he did it, I was like, "Oh my gosh, the transformation of this thing was profound." And
Sorry.
it's just pretty crazy
Potential
looking.
spam calling. Pardon me.
It's all good. It's all good. But that really got me into the like, okay, like you can actually transform these older communities and still make them look nice or much nicer than they look currently. Um,
Okay.
but I don't know. I drove through one yesterday in Lakeland that was you couldn't do anything to this one. It was just
They're
terrible.
probably in there.
I mean,
Lakeland
it
does
looked
have a
like,
big handful of those that, might benefit from like being converted to a place to nursery, let's say.
yeah,
Or
it
plants.
looked like,
Grow over those houses, they're almost grown over anyway.
yeah, that's true. It looked like this guy got a bunch of RVs and put them in a field, and that was his mobile home park.
Yep.
Yeah, so
That's an interesting business, that's for sure, and there's so many different strata in it, from the older trailers parks that you can then go in and approach very smartly and make it a great place to live by putting in some capital, fixing the homes, doing something with the roads, adding some landscaping, new signs, some lighting, better management. That could be a big deal. Your manager can be the quality of your on-site management or person overseeing that is the higher the quality, the better you sleep. The lower the quality of your on-site management people, the fewer great night's sleep you might get. I mean, I'm very concerned, very focused upon my assets. So if they're not doing well, for some reason, I think about them at about 3:50 in the morning. But in any event, yeah, that's really a key. You're such a strata of investment. I mean, the stuff you're doing is a great add value, great returns. On the higher end, I mean, most stuff that we did in Florida, we had, I don't know, 20 parks of 10,000 spaces. So they were big and they were institutional quality, but a whole different deal. The returns are different than what you would get and what you're doing. You would expect higher returns because of all the work you have to get those returns. But man, they can be really spectacular. And in a space where housing is expensive, it's getting really expensive out where you are. And frankly, in most everywhere, there are places that are kind of flat still, and the reason why they would be, but just makes the economy or people moving out and what have you. It's like the popsicle stick factory in Maine when it moved, like, the town became a ghost town. But the economic base has a lot to do with it, of course. But yeah, it's expensive. So if you take a little manufactured home or trailer, spend some money on it, somebody go out and buy that for, I don't know, 20 grand or 30, 40, whatever, 50, I don't know, depends if it's how old it is. It's an incredible deal compared to what the cost of a single family home is now in Lakeland, let's say, or any
yeah,
most populated places in Florida.
yeah,
I mean, Clearwater has become astronomical. And of course, you're in Orlando, also very expensive.
yeah,
So it really is, well, it's almost a public service making that type of housing available to people. It certainly is good societally speaking to help folks out by making nice, safer housing available by you taking on that risk, fixing it up, selling the home to them. Investors participate, and everybody wins. It's a great business.
yeah, yeah, for sure. Do you think that, Florida's a growing market, the Southeast, the Sun Belt, it's a growing market, population migration and whatnot. Do you think that there's you know, because 10 years ago, people said that, okay, well, rents will never be over $300 or $400 lot rent. Well, they're way over that now,
Yeah,
right? And 10 years ago, people were making, still probably some people were making $8 an hour, right?
yeah,
And
yeah,
now those same people that were making $8 an hour are making 15 or $20 an hour. Lot rents are much higher. If we're specifically talking about Florida, you're in the 6 and 7 and 800s in some places, and even more in some places. So, do you think? I guess two questions here. Do you think there's a cap on lot rent? And I'll let you answer that one first.
No. Do I think there's any top end to it? No. I don't imagine how there could be. Just have a inflation and deflating currency. So it's just a matter of what did your dollar buy you 4 years ago? Not nearly. I mean, you have to spend what, $1.30, $1.40 on food today, vis-a-vis that, let alone gas, which is double. But taking back even 20, 30, 40 years, take a look what that new Datsun or Mustang would have cost you back in the I don't know, 70s or whatever it was, versus today. There's no. It's the migrating pattern of cost and inflation up and up and up. Who knows where the rents will be in 10 years from now? Maybe $1,500 a month for a lot would be a heck of a steal, depending on the inflationary environment.
Right.
But it would make, unless you like to put in price controls, which, I mean, I've lived in areas where there's been, like in California where I am, there are plenty of rent control areas here, or going out to New Jersey or Massachusetts and so forth. And some people contend with that, deal with those issues. That adds a whole different layer of management, but and in many cases, it creates a housing shortage by the government trying to get involved with stuff. So certainly the free markets operate better than the bureaucracy. I think that's probably evident wherever you look, despite the fact that the bureaucrats may think otherwise. But empirically speaking, I don't believe that's true. And by observation, anecdotal evidence, the free market works better than the controlled market or completely socialized market.
Yeah, for sure. Yeah, and the reason why I asked you that, because like, in 2020, I could look at a deal and be like, okay, we're going to buy this for 40 or 45,000 a space. I could see it. Okay, there's a quick path to get it to 90, because I like to double the value of the property within that investment period, the 5-year period, through converting park-owned homes, maybe filling some vacant lots and rent increases and decreasing expenses and whatnot. But, I'm out driving deals yesterday, and there's a deal, it's just harder for me to see, hey, you're buying this for 100 a pad and it getting to 200 a pad. It's like, it's harder for my mind to sort of conceive that. But, and the reason why I asked you, because, 10 years ago, people were making less. 10 years from now, maybe people are making $30 an hour. Wages have increased and whatnot. And really we're just, we're a factor of apartment rents. And, the average apartment rent in Orlando is like $1,700. So maybe that'll be, 3,000 in 10 years, 2,500 to 3,000.
Yeah. Yeah.
So, I do see that side as well, because I think even, if you look in you used to be in the apartment business. Would you ever have thought that multifamily would be trading for $300,000 a door, or even $500,000 a door in some markets?
No, it's
Yeah.
astounding.
Yeah.
And I don't know how it works. I guess it does, but a lot of it's, I guess, maybe really patient money. Well, I'll wait. I don't want to keep it in the bank. I think that drives part of it. But yeah, you're right about these being able to double the way you're looking at it, and also the what people are making. For example, my management company, very involved in the HOAs there. I just don't get too much involved with, but manages our parks and some third party management. But up in my head office is up in Crystal River, and we have an office in Newport Richie. Unfortunately, the one in Crystal River, man, that place was just devastated. Unfortunately, through this Helene, it's been unbelievable what's happened up and along the places that are close to the water and whatnot. Anyway, not to digress, but there was my partner in the management company, and she's been in business together since 2011, but we knew each other much earlier than that when she was an on-site manager at a property in Portland. But she went on to become division president for Hometown America, and highly accomplished person of the year for Florida Manufactured Housing, FMHA, what have you. Anyway, so she goes, Lee, look at this place that opened, because we're trying to hire somebody into the office. This place just opened up over here on Highway 19, a new shopping center. I don't know, it's a Hobby Lobby or something like that. But they were hiring people to come to work there for like $18 an hour,
Wow.
So if somebody's making $18 an hour, first of all, I guess a lot of folks these days, the younger generation, I don't know collectively, but a good cohort of it isn't all enthused about working, really, from what I can tell. So, which is an interesting notion. I don't know how they buy for the long run, but there certainly is value to work. Not only that, it's good for your morale when you're at work and are making money, as opposed to being the receiving end of handouts, what have you. But other than, so you're looking at having to spend that kind of money to hire somebody. That's some pretty good money they can spend on rents then. So I think you're probably seeing that all over your area where people are making more and more and more. Of course, they can pay more for rent of a space, but then you and I as owners also have to absorb or deal with or pass on the costs that are associated with ownership. Insurance has gone crazy, hasn't it? And then you've got, depending where you're located, property taxes, electricity, power is through the roof. If you're doing any rehab of anything, the labor costs are through the roof, supplies, materials are gone way up. So all these things influence what should drive your rent level up. So you're at least maintaining, if not increasing, your ability to make a reasonable return on your investment.
Yeah. Yeah. And I think, and I think in our asset class, because of the, affordable housing aspect and low supply, that, we can work with that. Apartments, I think, you have a different problem because if I have a class B apartment, 300 unit complex here, and Lee builds one next door that's $100 extra a month or whatever, and he's given all these concessions, he's going to fill it up, right? And then I'm screwed. So that's why I do love our asset class. I think the future is bright. I used to work at Kmart, by the way, in high school. I was making $6.25 an hour. I didn't like working either.
I used to work at Safeway in grade school, high school.
How much did you make?
Can't even tell you what it was back then. I know a bag of groceries was valued at $5 then, so you can see what's happened right now. But yeah, things change. Like Kmart, they're gone. Right?
They're gone. Yeah, they're gone. I know my wife, she goes to Costco, and I look at the Costco bill, and I'm like, what'd you get?
Yeah, I know.
For $500.
Yeah, I know. It's very infrequent you can get out for double digits. Got a lettuce, some crackers, some hummus, under $10. Other than that.
Yeah. Well, Lee, I really appreciate you coming on. I appreciate you sharing your knowledge and wisdom with everybody. And I know it was hard to get you on. I had to get to your publicist and through all your team to get to you.
Pay me a lot of money. I mean, I don't know what I'm going to do now. Possibly, I've always wanted a large yacht, but after speaking with you, perhaps the dream comes true.
The dream will come true. The dream will come true. Well, everyone, thank you all for tuning in to the MHP show. We will see you all next week. And don't forget to like and subscribe, leave a comment, follow me at Derek Vickers 885 on all social media platforms. If you have an interest in applying for our mentorship program, we have a spot opening up in that. You can reach out to me on social media or shoot me an email at derek@victorycapital.com. And we'll see you all next week. Peace.
Thanks, Derek. Take care. Be safe.